What happens when the market moves and your thesis doesn't? Honestly, death. The data tells the story plainly. Carter reported that from 2021 to 2024, the number of new funds created dropped by 68%. 9 firms now control nearly half of the capital raised in a given year. LPs aren't allocating to new funds because they haven't seen returns from the old ones. In this environment, a fund whose thesis doesn't evolve with the market doesn't just underperform, it disappears.
Great wealth demands great wisdom. Great power demands great care. This is Principles of Benevolence. So let's explore how to build companies that matter, invest with intention, and lead with benevolence at the core.
Most people think that an investment thesis is an area that you invest in: healthcare, fintech, AI. That's a general overview of what you invest in, but a thesis provides the how and the why. I'd argue that this is one of the most critical steps to firm building is the investment thesis. It uncovers your deeply held beliefs, is grounded in research, and provides a forward-looking outlook on how you're going to deliver top returns and transform society for the better. It's basically an overview of how you see the world, what's your secret sauce, and what makes you an outlier worth betting on. Now, I'll preface all of this to say that I don't think that there's any formula to create an investment thesis. I think that this is all more art than science, and it's something that is likely to evolve over time as the market changes. Today, I want to walk you through how I've gone about creating different investment theses as a VC over the last decade. I'll share general strategy for creating a thesis. I'll drill down into a focus on purpose-driven companies, and I'll talk through pitfalls that I've encountered along the way. So hopefully you don't have to do the same. If you're ready to move from the passenger seat, where you're looking to YC and VC luminaries to tell you what the next hot market that's worth investing in, to the driver's seat, creating a sharpened thesis, aligning more closely to your strengths and values, this is the episode for you. I'm calling all scouts, angel investors, family office and endowment leaders, and anyone who wants to move with more intention, not just follow the crowd, turn the volume up. When you first develop a thesis, it's honestly a hypothesis. You have your values and vision of what's needed in the world and where are gaps in the market. Once you have your hypothesis, you can do a deep dive on the space. You can do broad research across a sector like healthcare, where you can identify the market drivers, the headwinds and tailwinds, the competitive landscape, and what are the things that might increase or slow the acceleration of that technology in that specific area. Or you can drill down into a specific area within a larger market that you think that there is a attractive market opportunity. So say, for instance, that you notice with the aging population of baby boomers that it probably will lead to an increased need of healthcare workers, right? That's my hypothesis. You then drill down into that specific use case and use the same framework that you would use for the larger market assessment. AI makes this market research easier than ever. It'll spit out a competitive landscape, market analysis, and risk assessment in minutes. The availability of information for everyone makes the understanding of the gaps common knowledge, honestly. What separates top investors is the proximity to the space, those building, consuming, and investing. Part of my secret sauce is that I'm a convener of people, connecting the dots for everyone along the way. Okay, so I'll let you in on one of my tactics. One way that I create a flywheel of value, collecting raw insights that help to develop my thesis, building relationships with customers, and connecting founders to resources, is by convening stakeholder roundtables. I learned this tactic from my accelerator days when I was designing entrepreneurship program for early stage founders. Say I'm creating a thesis on workforce development. I would host a roundtable that would include an array of stakeholders. I would have college presidents that are trying to think about the ROI of a degree. I'd have corporate executives that are thinking about their future pipeline. I'd also have foundations that are investing in the space and policy leaders that are helping to influence where public private partnerships could help with workforce development. These convenings usually would surface insights of what are the top pain points that this market is facing from multiple different angles. I would take and distill those insights to then help influence my sourcing efforts within that area that I was interested in for workforce development. During COVID, customers were slammed with cold inbound from entrepreneurs that a lot of them stopped responding to that at all and only was receptive to warm intros for different vendors that they were thinking about using technology. I acted as a Trojan horse for my portfolio companies. I collected some of their outbound cold customer lists and did outreach to thousands of customers, telling them that I was convening roundtables of superintendents, of provosts, of workforce leaders to talk about the pain points of COVID in a peer setting. During that conversation, I was able to uncover like what were some of their top pain points. And from that, I made connections to entrepreneurs in my portfolio that were solving those pain points. I did this to act as the warm lead and to broker relationships and hopefully get them business. Roundtables are something that I like to do when there are big market shifts or when I'm researching a new thesis area. But you can do them as often as you need to keep your thesis fresh. Other mainstream tactics for gathering information and insights to develop your thesis include going to conferences, building relationships with other investors. It's a good idea to think about investors that invest larger check sizes than you but might be in the same area, or invest smaller checks than you but are interested in similar theses. It's a great way to share market insights and deal flow because you're not really competitive. There are various hype cycles that occur when investing. I remember back in 2020, in COVID, there was the explosion of virtual meetings and online learning. Then came Web3, AI, now physical AI. As an investor, there are always shiny objects, distraction, and FOMO when evaluating deals. But a key trait that strong investors possess is the ability to find the signal through the noise. Okay, so we've talked through how to develop an investment thesis. Now let's walk through the harder part, how to know how to test it and evolve it. You're going to hear me say that a lot clearly during this podcast episode, but I don't think that there's one way to also know when to evolve your investment thesis. I think the key is to know that you need to stay curious. You need to keep learning constantly about your industry. It's not just like a set it and forget it for investment thesis building. Stay true to your own conviction. Don't chase the opinion or validation of other investors because honestly, no one can predict the future. And there are so many ways, or historically, there have been so many ways to win at venture investing. I'll describe a few scenarios where I noticed a natural evolution of my thesis and also areas where I got stuck. Okay, let's start with where I got stuck. And this is probably true of a lot of purpose-driven investors, or maybe even stubborn investors, is when you get too caught up on your researched hypothesis and how you want the world to look, that you'll try to force an investment in that area whenever you see a company that fills that gap. As investors, we have to remind ourselves, just like we tell founders, that an idea isn't enough. You have to have the team that can execute on the idea, and also the market has to be ready. As an example, I was gung-ho about the apprenticeship market a few years ago. With the rising cost of higher education, I was trying to find a way that students could go from high school straight to career to avoid that debt. There's a great example of this in the UK where employers get subsidies from their government to employ students straight out of high school through the apprenticeship model so they can learn the ropes of the industry that they're entering in. I was hoping to find something comparable in the US, but unfortunately, there aren't the same kickbacks here to incentivize employers to adopt apprenticeships on the rate that I needed at the time to grow a successful venture backable business. Employers are like, why wouldn't I just go get a college graduate where I can still pay a few dimes and they have more education? It's easy to overhype a deal that fits within the vision of how you think the world should work, but it also should surpass all of your hurdles and stress testing, just like any other deal that you're evaluating. People have different thoughts on this. Some investors are like, I like doing it solo, I trust my gut, and that's all I need. I'm someone where I like to get other eyes on the deal and have a bit of a devil's advocate banter to make sure that I'm not making decisions in a vacuum. Reviewing hundreds of deals day in and day out, you start to develop a pattern recognition of high quality deals, founders, and signals of where the market is heading. Speed that the startup space has been evolving since 2020 has been neck breaking. I was a partner at an ed tech fund, and I can remember a few years back going through a long period, say 6+ months, where I was not seeing a lot of high quality education deals for us to invest in. I love education, but I think of it as a vehicle to economic mobility and prosperity. At my core, what drives me is getting people connected to the resources that they need in general, with education being one of them. But I also have interest in healthcare, in jobs, in financial access. And at the time, I was seeing a lot of attractive deals in some of those spaces, but because of the parameters of our investment thesis, I would usually just pass them on to other investors that I thought they would be helpful for. I started toying with the idea and talking with partners one on what it would look like if we evolved our thesis beyond education. And education was in our name. So that was an idea that didn't necessarily come without pushback. So during one of our offsites, I facilitated a brainstorming session where we could play around with the idea of revising our thesis. I asked everybody to zoom out and to ask themselves, are we investing in education for the sake of education? Or is what we truly care about helping people to have an improved quality of life? And if the latter, what are the potential markets that we could explore that we're not currently investing that could have a similar outcome through a different means? We all had our sticky notes and started to tally them up. And there was a lot of interest in mental health and healthcare and caregiving and financial access, among others. I slowly was able to get people on board with exploring the idea of involving our thesis to explore different high growth areas in the market currently that are also supporting the populations that we wanted to serve. With a track record of investing in education for a decade, we had to think about how do we approach this thoughtfully, and also how do we bring our investors along the journey with us because they invested in us for our investment thesis. I expanded our investment scope to education, work, and life skills. So we already invested in education and workforce. I then bucketed life skills. You see, skills connected to learning, trying to keep it all the same. But I bucketed life skills as care economy, as healthcare, as financial access, as all the things or skills that one would need to have a better quality of life. It was not an easy adjustment. Bringing new deals in front of the investment committee in areas where people were less familiar and trying to get buy-in, but eventually people adapted. Limited partners invest in you as an investor to be able to read the tea leaves and make the right decisions to steward and grow their money. I honestly think that we should have shared our evolved thinking of our thesis with the world, not a reluctant internal mind shift, because another fund in our space came to a similar conclusion almost a year later, but they did so in a full-throated, we have conviction on this, public kind of way, which honestly made us look like a laggard in the market in an area where we could have provided leadership. What happens when the market moves and your thesis doesn't? Honestly, death. The data tells the story plainly. Carter reported that from 2021 to 2024, the number of new funds created dropped by 68%. 9 firms now control nearly half of the capital raised in a given year. LPs aren't allocating to new funds because they haven't seen returns from the old ones. In this environment, a fund whose thesis doesn't evolve with the market doesn't just underperform, it disappears. Capital concentrates around the firms that saw the market shift coming and positioned accordingly. Everyone else is competing for the scraps. My advice? Stay nimble, stay curious, and never settle on a fixed view of the world. The market will move. The question is, will your thesis move with it? My current thesis is simple. Capital deployed with intention creates better outcomes for investors, for founders, and for the communities they serve. That's what I'm building at Benevolent Advisor, and that's what every guest on this podcast is proving week by week. Thank you for listening. Thanks for listening to Principles of Benevolence. If you like the show, please subscribe, rate, and review on Apple or your favorite platform to listen to podcasts. And as an act of benevolence, share with an ambitious friend who wants to build a life with purpose in mind. You can find me at Principles of Benevolence on IG, LinkedIn, and YouTube, and principlesofbenevolence.com. Until next time.